It's Friday morning. This is the next to the last day, so most of you seem to have survived fairly well. I don't see too many, nervous tics or other issues that may have come up during the week. Hope you've enjoyed yourselves, and hope that you'll continue to hang in there for a couple more days with energy and enthusiasm. Our topic this morning is the corporation and the free market. The corporation and the free market. The corporation, of course, is a ubiquitous form of organization in advanced economies. Advanced economies with a complex division of labor have always been had major roles played by very large companies. Okay, so that's not to deny that smaller firms, that startup firms, that one-person entrepreneurial firms, if you like, are extremely important for innovation and economic growth. They surely are. But in the typical Western economy today, if you look at rough and ready figures, something like 80% of the output is produced by about 20% of the firms. So there are many more small firms than large firms, but large firms produce the vast majority of the consumption goods that we all benefit from. So what is it about large firms? Is this something that we should celebrate? Is the emergence of the large company, and particularly the corporate form of organization, the limited liability company, is this a natural phenomenon that emerges sort of organically on the free market? Is this an artificial construct that owes its origins somehow to the state? Is the corporation something we should celebrate, or is it a form of organization we should worry about? Naturally, the corporation has had its critics from its earliest inception. Many of them simply critics of the free market more generally, right? So you have the typical kind of leftist critique that large private organizations seeking profit, putting profit ahead of people and this sort of thing, are inherently evil and corrupt. And we'll talk about those critiques a little bit today. And I hope to show you that that those criticisms are fairly easy to refute. Now, there are also some more sophisticated critiques of large firms, and particularly the corporate form of organization, that have come out recently from people who have a more or less libertarian orientation. So there's a so-called left libertarian critique of the corporation, which I think is a lot more interesting than the standard sort of leftist critique. However, as I hope to show you, equally fallacious. We'll get into that a little bit when we talk about the famous Klein versus Roderick Long debate, or as I prefer to call it, the Klein smashing of Long. But Roderick's not here to defend himself, so of course we'll have some fun with that. Okay, let me talk a little bit about the structure of the corporation and begin with sort of the most important, historically important critique of the large company, in particular the corporate form of organization that you find in the literature. And this critique in its most celebrated form goes back to the 1930s, and a famous book by Adolf Burley and Gardner Means, published in 1932, called The Modern Corporation and Private Property. This is a book where they introduced the notion of the so-called separation of ownership and control. So-called separation of ownership and control. Burley was a law professor at Columbia. He and Means were both important New Dealers. They're very tight with the Roosevelt administration, bureaucrats essentially. And in this book, they argued that the modern 20th century corporate form of organization was inherently flawed. Inherently flawed. Now let me explain what they had in mind. Okay, we've been studying this week when we talk about production theory and the theory of the firm, and how entrepreneurs seek profits and so on. We've been talking mainly about the firm in a sort of abstract sense, right? So there's an entrepreneur who is seeking to purchase factors of production on the factor market and combine them in ways that generate output that is more valuable, adjusting for time preference, right, than the value of the inputs, the prices of the inputs that are used to produce them. If the entrepreneur is successful in doing that, right? And can produce goods and services that can be sold on the market for greater money returns than what the entrepreneur invested in money terms in purchasing the factors. Taking time, preference, interest rates into account, the entrepreneur has earned economic profits. Okay, and it's the actions of profit-seeking entrepreneurs that align the structure of production with the pattern of consumer wants. Right? We've talked about that issue this week in the theory of the firm and the theory of the entrepreneur, even in the Austrian theory of the business cycle. So we're all familiar with that general model. Okay? What if we change the problem and talk about the firm not so much as the entrepreneur by himself and the factors of production he owns and transforms and so on, but rather we think about the firm as a collection of people, right? So if we move from the one-person firm to the multiple-person firm, we have some additional issues to consider, right? So the entrepreneur also assembles a team of people, perhaps to realize his or her objectives. And those people are, maybe some of them may be partners, they may be joint investors in a project, or they may simply be salaried employees working by contract. And once the entrepreneur is directing a team of individuals, things become a little bit more messy, right? People, managing, organizing, and governing people is not exactly the same as managing, organizing, and governing machines or equipment or tools or what have you. Okay? So the entrepreneur has to come up with some way of giving people appropriate incentives to take the actions that the entrepreneur wants. There may be issues related to the knowledge or information that particular individuals on the team have. If it's a group, as in a partnership with some shared responsibilities, there are problems of collective decision-making and so on, organizing teams, etc. All right? Now, according to Burley and Means, these organizational or managerial or governance problems rendered obsolete or irrelevant all of the standard arguments about firms seeking profits and arranging resources in ways that are economically efficient in the sense of helping to satisfy consumer wants. In other words, they said, okay, maybe it's true that in an economy of one-person firms, maybe it's the case that those firms are seeking to increase their profits by satisfying consumer wants, and maybe you get an efficient or effective distribution of resources in society. But, they argued, that world is gone. Now we're in the world of big companies. What characterizes big companies, especially if they're joint stock or shareholder companies? Well, those who own the company, right? And in a corporation, of course, the owners are the shareholders, right? The shareholders are many, and they're often spread out all over the economy, and they may not exercise much day-to-day control over how the firm is run. So, according to Burley and Means, large firms are run in practice on a day-to-day basis by managers who are not themselves owners of the company, but are rather, hired hands, salaried employees, whose objectives may or may not be consistent with the profit-seeking goals of the owner-entrepreneurs. Okay? Maybe they argued these managers really seek just to maximize their own personal benefits or perks. Right? The managers prefer higher salaries, they want fancier offices, they want to fly in a corporate jet, they want to stay in first-class hotels when they travel. Maybe they prefer running a large firm to running a small firm. So even if expanding the firm is not profitable, doesn't increase profits, they might want to do it anyway, just because, it's more fun to be captain of a bigger ship than a smaller ship. So these salaried managers may engage in acquisitions and diversification and all kinds of company programs that don't, in fact, advance the interests of the shareholders, the owners, but rather benefit these managers themselves at the expense of the shareholders. Okay? So there's a separation in the modern corporate form of organization, according to Burley and Means, between ownership and control. And this wedge renders obsolete or irrelevant any claims we might make about owners of the firm being able to run the firms in ways that increase profit by benefiting consumers. Okay? Therefore, they claimed We need tighter government control over corporations or particular kinds of securities laws or even antitrust laws to break up corporations. And essentially capitalism is inefficient, and that's why we need all the New Deal programs and so on, not surprisingly. That's always the conclusion, right? Now, what can we say about this argument? Well, like a lot of, clever arguments, it's not entirely wrong. I mean, there is an element of truth in the claim that a large, modern, multi-person organization is different, it's more complicated, and is more difficult to run than a small, sleek, one-man show. There's no doubt about that, okay? Does it follow that the corporate form of organization in particular, and the large company in general, is therefore inefficient, ineffective, would not emerge on the free market, or does emerge on the free market but should be broken up or whatever? And I would claim the answer is no. And let me explain why. Okay, first I want to get out of the way one point that is often sort of a sticking point for people on this issue. Namely, it is absolutely true that the owners of a corporation, shareholders, people like you and me, if we own stock in companies, or if we have shares in a mutual fund or a pension fund, right? It is absolutely true that we don't operate the companies that we own jointly on a day-to-day basis. Okay? If you own some shares of stock or you have shares in a mutual fund, I'm guessing that none of you, even if you have owned shares in publicly traded companies, have ever shown up at a stockholders meeting, and stood up and made an objection or made a speech on the floor or, tried to put forth some motion to change the policies of the company. I'm guessing it's very unlikely that any of you have done that, right? Most shareholders are content to sort of free ride on the efforts of, institutional investors and large block holders and other people who are, who are more active in managing the firm. We're happy to collect our dividend checks, if any. We're happy to watch our shares appreciate if they do, sell them off if they don't, and so on. Okay? Yet it is true legally that we as shareholders are the owners of those corporate assets. Okay? But think about it. This problem is not unique to corporations, so-called separation of ownership and control. You can imagine a mom and pop store, right? A little convenience store that's owned by, I own a little convenience store. I mean, I may not be there behind the counter every day, right? I might hire, is it Jan? I might hire Jan, to work the counter and while I go to lunch. Okay? Or maybe I go on vacation for 2 weeks and leave him in charge. Or maybe, I go live in the Bahamas year round and I let him, run the little mom and pop store for me. Does that mean that I am being sort of taken advantage of by him? Well, not necessarily. Why? I mean, it's true that he may not be doing things exactly the way I would have done them. Maybe he's even goofing off or closing the store early, right? But remember that my choice to delegate authority and responsibility to him was a choice by me, right? I voluntarily delegated my day-to-day decision authority to my manager, right? The fact that I hired him, I chose him among all the people I could have chosen. I decided what decision rights to delegate to him and which ones to retain myself. So, for example, I may have said, Jan, you can decide what time you open in the morning, what time you close at night, but you can't, sell the firm to my neighbor across the street. You don't legally own the firm. That's something you can't do, right? So I choose what rights to give him and what rights to retain for myself. And, best of all, I can fire him if I don't like him. Oh yeah, I can give him the axe and replace him with Isaac. Maybe that's, might be a better idea, right? So even though I have sort of voluntarily given up some day-to-day authority, that doesn't mean in some sense that I'm not in control of the company, right? So control doesn't mean doing everything yourself. Delegation is a form of control, right? If you have the right to delegate and then the right to take back some authority that you've previously delegated, that is a way of exercising control. Okay, so there's nothing sort of necessarily inconsistent with the idea that owners who ultimately control resources aren't the ones who are deciding on a day-to-day basis how they'll be used. Okay, so let's get that out of the way first. right? Now that having been said, in a practical sense, look, I'm in the Bahamas, I'm having a good time at the beach, I'm drinking pina coladas or whatever. I really don't know what Jan is doing. Okay, I mean, he seemed like the best guy to run the firm when I was, trying to hire a helper. He seems like a pretty good guy, but, how much do I really know? I mean, maybe he is running the firm into the ground, or who knows what he's doing. He's grabbing money out of the cash register, something like that. How much of that is a little bit of that a big deal? How important is it to me? And is there anything I can do to try to limit the amount of discretion that he may exercise? Okay, what can I do in a practical sense to affect tighter control? Well, if we think about large companies in particular, although this would apply to the mom and pop store to some degree as well, there are a series of, call them control mechanisms, that owners of large firms have, that shareholders have. Ways that they can, if not completely eliminate, at least constrain or limit the amount of discretion that hired managers have. Okay, and it's conventional in the literature on corporate control and corporate governance to distinguish between so-called internal and external mechanisms of control. Internal control mechanisms and external control mechanisms. Right, by internal we mean inside the firm, external, outside the firm. Okay? Can you guys see the bottom of the slide in the back? Not real well? Okay. There's really good stuff down there. Sorry, you're just going to miss it. No, I'll read it to you. So, internal mechanisms include things like setting up a board of directors. Okay? So, for example, we as shareholders, if I own a few shares of Microsoft or Google or whatever, I don't necessarily vote on every decision that the company makes, but I may vote on who to sit on the board of directors, right? So we establish a governing board that we as the shareholders elect, and we task that governing board with supervising the decisions of the top managers, okay? It's possible for us to vote on critical decisions, including who the top managers are, through the ballot process, so-called proxy contest. Okay, so there may be, different groups of managers with different views or different blocks of shareholders with different ideas about how the company should be run, and we as joint owners, shareholders, can vote. And the decision can be made that way. One group of managers might want to replace the incumbent managers, and they could put that out for a proxy ballot, and we as shareholders could vote on which manager we want. That's not necessarily the most effective way to make decisions, but it can be used. Furthermore, we as owners may, acting through the board of directors, institute compensation policies for our managers that are based on performance, namely the performance measures that are important to us. Okay, so suppose that we as shareholders want to maximize the market value of our firm. So we want the highest possible stock price, contingent on the number of shares outstanding. Assume that the managers, the hired managers, they prefer to maximize their own salary and the perks they consume. Okay, well, one thing that we can do as shareholders is simply write a contract such that their compensation, their salary, is a function of the stock price. Okay, or whatever performance variable, accounting profits, or some kind of return on investment measure that we, the shareholders, want. So we try to align the interests of the managers with our interests as shareholders by making it so they get more pay when we get what we want. Okay? And one easy way to do this is to make the managers themselves part owners of the corporation. Right? We can make some of their compensation be stock or stock options rather than fixed, compensation, and help to align their interests with owners that way by making them part owners themselves. Okay? And there's also, both inside the firm and also outside the firm, some sort of competition among managers. Okay, so there's an internal market for managers within the company in the sense that managers are competing to some degree for top spots. Now, why is this important? Well, think of this as sort of, by analogy, think of the typical mafia organization. Okay, so think of a guy like, who's a famous modern mobster, John Gotti. You guys know who John Gotti is? Right? He was head of the Gambino family before he was put away. How did he get to be head of the Gambino clan? It's because he's good. Yeah, he had to have support of the rest of the family. But at some point he was like a capo, a lieutenant under a previous don of the family. And what happened to that previous don? How? Yeah, but he was offed by John Gotti. Okay, often the way you get to be head of a mafia family is by killing the previous head yourself. Okay, what does that mean? Well, look, if I'm a top manager of a company and Brian's the CEO, okay, and I'm some kind of vice president, but I think that Brian's not doing a good job. Okay, remember, I have a greater ability to monitor him than a randomly chosen shareholder has. Okay, I'm close to him. I see what he's doing. I know what's going on in the firm. So I have the ability to monitor him, and I have an incentive. If he's shirking on the job, if he's giving himself a lot of perks and he's really not running the firm effectively, I have a strong incentive to go to the board and say, look at him, tattletale, get rid of him and make me the CEO. Okay? So managers have incentives to monitor each other and report any malfeasance to the board, to shareholders, and so on. Okay, so the fact that your underlings are watching you very closely constrains the behavior of the top management and limits the amount of discretion they can be engaged in. Okay, now all of these can be more or less effective measures, but an even greater or a more effective set of control mechanisms is the ones that are typically called external. Right? So these are things like competition in the product market, discipline from suppliers of capital, and perhaps most important, competition in the market for corporate control itself. Competition in the market for corporate control. Right? What do we mean by this? Well, take the product market first. Right? If Brian is running the company poorly, presumably it will not be producing the goods and services that consumers want. Its revenues, its sales will fall. Right? And it faces competition from other firms that are trying to serve those same consumers. Those other firms maybe serve those consumers better. The firm goes, it becomes less profitable. Eventually it goes bankrupt. He loses his job. Okay, so the fact that these managers are competing with managers of other companies gives them an incentive to try to do what the owners would do if they were running things themselves. Namely, produce the goods and services that consumers want. Okay? There may also be constraints from suppliers of capital. Now, in the Anglo-American system, in which the primary source of capital for large companies is public equity markets, stock markets, well then that's the whole point of the Burley and Means problem, right? That the stockholders are not in a position to exercise much control. But in many other parts of the world, important suppliers of capital for large firms are other large institutions like banks, like pension funds, venture funds, and so on. We have some of that in the Anglo-American system, but much less because of legal restrictions. Because banks are not allowed to own shares of equity in the U.S. and U.K. system. In continental Europe, in Japan, and other systems where banks play a much more active role, it turns out that they are some of the corporate governance problems that we worry about here. Are not present. Thought I had another picture there. So in principle, we could have discipline from large institutional investors and capital suppliers like banks. But perhaps most effective of all is the so-called market for corporate control. And this idea was first elaborated in an article by great sort of neoclassical economist named Henry Manny in 1966, called Mergers in the Market for Corporate Control. And in this article, Manny made the following, it's M-A-N-N-E, Henry Manny, M-A-N-N-E, who's still writing. The argument that Manny made was the following. He said, imagine that firms are funded by stock, okay, and shareholders have the option to invest in one firm or another. Okay, go back to this scenario where Brian here is running the firm into the ground. Okay, if he's, producing the wrong goods and services, very inefficient manager or whatever, so it's such that the profits of the firm are falling. right? If the firm is publicly traded, right, what effect is falling profit going to have on the stock price of the firm? It's going to go down. Why? I'm sorry? Okay, and why? I mean, what's determining the price of the stock in the first place? Right, so people who are considering holding a share of the stock are trying to anticipate, what do we think are the cash flows that this firm will generate, the stream of dividends that a share of the stock, that will accrue to a share of the stock over time. Right, so the price of the stock is based on the expectations that buyers and sellers of stock have for the stream of dividends generated by cash flows that this company that this share will produce. Okay, so if investors, if financial market participants see that the revenues of the firm are going down, for whatever reason they think that the firm performance they're not happy with the performance of the firm, then fewer people want to hold the stock, right? So the price of the stock will be bid down on the stock market. Okay, now it turns out there's a class of individual entrepreneur investors who specialize in looking at the corporate landscape for companies with stock prices that are falling or that seem to be below what you would expect based on, the so-called fundamentals of the firm. People who, of course, are mistakenly and pejoratively by journalists referred to as raiders. Okay? Corporate raiders like Michael Milken or like the Gordon Gekko character in Wall Street. Right? Now, the term raider brings to mind something like this. A guy who uses coercion, swords and guns to chop off people's heads or whatever. But of course, a so-called raider in private capital markets is simply an individual who buys and sells companies. Okay? So a person who, so there's a Michael Milken type or a Gordon Gekko type out there. He sees that, the share price of Brian's firm is very low. He thinks, Brian makes a pretty decent product. He's in well-positioned in his market. He ought to be making decent profits, but he's not for some reason. And investors perceive that he's not going to be making more profit in the future. Maybe the problem is Brian. Okay, so if I, the raider, if I can acquire enough of the stock of Brian's company to take control of that company, then I can get rid of him and put in a new manager of my choosing. Okay, why would I do that? Well, I would only do that if I think that I can purchase a majority stake in the firm, get rid of him, put in new managers, make other changes, and bring that stock price up, right? And then eventually sell the stock back to the market and sell it for more than what I paid. Okay? So the raider is a profit-seeking entrepreneur in the Misesian sense of investing some resources in the present in anticipation of generating returns in the future. Okay? Now, the raider may or may not be successful, right? It may turn out that I kick out Brian, I put Floy in charge, and maybe she doesn't do any better. Okay? And I end up with stock that's worth less than what I paid for it. That's a possibility. That's the uncertainty that I bear as a Misesian entrepreneur, right? But if I'm good at it, right, maybe I see something that other people don't see, and I see that I can acquire control and make some money. How do I do it? Well, often the way I acquire the resources to buy the stock is by borrowing. Okay, so-called leveraged buyout, LBO or leveraged buyout, is simply a transaction of this type where the raider, the financier, floats bonds, basically borrows money to buy the stock, and then uses the proceeds, the profits from the reorganized firm to pay off the debt. Okay. Could also be, instead of a raider, there could be another firm, right? So, Isaac is, managing a large firm, and he sees that Brian's firm is doing badly. So his firm acquires Brian's firm. They merge, or there's some kind of an acquisition of one firm by the other, and then Brian gets kicked out and replaced by Floy. Okay. And of course the media, if Brian is not too thrilled about this transaction, in other words, he would prefer not to be ousted, but instead Isaac's company or the raider goes to the shareholders of Brian's firm and says, hey, we'll give you this, we'll pay you, or we'll give you shares in our firm if you'll give up or tender the shares in your firm, then we'll replace the management. If Brian's not too happy about that, the media calls it a hostile takeover. Okay, again, it's like guns and knives, and like a friendly takeover is good and a hostile takeover is bad. Hostile takeover just means the management of the firm being taken over would prefer not to be taken over and fired. Okay. I'm sorry, did you have a clarifying question? Yeah. Right. Yeah, of course. I mean, it's not shareholders who complain about raiders and corporate control transactions and greed on the financial markets and so on. It's establishment figures, primarily powerful managers of incumbent companies, who would obviously have an incentive to resist a mechanism like the market for corporate control. Okay. Interestingly, Mises refers specifically to this kind of phenomenon in a part of Human Action where he reflects on the socialist calculation debate. And let me put this in context for you because it's extremely interesting. I think it hasn't received a whole lot of attention even among Austrians. That if you remember, Mises made the argument in his 1920 article and his 1922 book that, absent private property in means of production, absent markets for factors, there can be no prices of factors, and therefore there's no way for entrepreneurs to allocate capital resources to their highest valued uses, okay, because they lack a price mechanism, they lack the ability to buy and sell capital resources. There were, a number of responses to Mises' critique, particularly by a group of economists known as market socialists, people like Oscar Lange, Abba Lerner, Fred Taylor, who were themselves trained in economics, so they were sort of economically literate. They understood the thrust of Mises' critique, or they thought they understood the main part of Mises' critique. They understood that you had to have money and prices and so on. But one of the market socialist proposals was to say, Mises is right that a purely hierarchical socialist command and control economy with no money and no prices and so on, that obviously couldn't work. But what if we had something that's kind of a hybrid where the government owns all the means of production, right? So the government owns all the capital equipment, the government owns all firms, all productive units are government-owned enterprises, right? And we put managers in charge of these government-owned enterprises, and then we allow consumers to buy consumer goods. So we have a market for consumer goods. We let the state control the productive sector, but we do allow there to be private commerce in the retail sector. Okay, they argued that, we just basically give these managers of socialist enterprises the same kind of instructions you would give to the manager of a capitalist firm. Namely, try to maximize profits by setting marginal revenue equal to marginal cost. They said, that's what a manager of a private company does. Right? And as Burley and Means and other people have shown, right? The managers may not themselves be owners. They may just be employees. So what's the difference between the, manager of the local Walmart being told to, choose what to sell and how to price your output and so on, so that you maximize your profits? How's that any different from, somebody running a socialist enterprise? Tell them to maximize profits too. It's just as efficient. Okay? Mises responds to this in Human Action, in a passage where he's talking about, where he explicitly brings in the role of the financial markets. Let me show you this quotation and then, help you and tell you what I think Mises means. This passage where he doesn't refer to Burley and Means by name, but he's talking about the Burley and Means idea of separation of ownership and control. And again, this is in the section where he's talking about market socialism, where he's critiquing the market socialists. Mises says this idea, the Burley and Means doctrine, disregards entirely the role that the capital and money market, the stock and bond exchange, which a pertinent idiom simply calls the market, plays in the direction of corporate business. The changes in the prices of common and preferred stock and of corporate bonds are the means applied by the capitalists for the supreme control of the flow of capital. The price structure, as determined by the speculations on the capital and money markets and on the big commodity exchanges, not only decides how much capital is available for the conduct of each corporation's business, it creates a state of affairs to which the managers must adjust their operations in detail. Okay? What he means is, even in a capitalist economy, even in a free market economy, the most important arena of entrepreneurship is not the actions of, people running firms, deciding what inputs to purchase and what price to put on their output and so on. That's important. But even more important than that is the larger process that decides how much capital will be allocated to these managers or entrepreneurs. Okay, so it's the action of the, speculators on the capital and money markets and on the big commodity exchanges. These are the means applied by the capitalist entrepreneurs for the supreme control of the flow of capital. Okay, so the price structure as determined by what goes on in financial markets creates a state of affairs to which managers of companies must adjust their operations. Okay? Put it this way. If you take a standard course in microeconomics, you're presented with the model of the firm, right? You've seen those diagrams with cost curves and revenue curves and so on. You say, well, given these cost curves, given these revenue curves, how do you maximize profit? What should the manager do? And it's a pretty easy problem, right? I mean, you look where some curves intersect, or maybe where there's a tangency if you're doing something fancy, right? You say, we just set marginal revenue equal to marginal cost. We maximize profits. We're done. Okay. What Mises is arguing essentially is that isn't the most important problem. That's not the main problem solved by a capitalist economy, how to choose price and quantity so that MR equals MC. No, rather the main problem is, a more important issue is, how did that manager come to be there in the first place? How did there get to be a firm or a plant there producing output with a manager in charge looking for where marginal revenue equals marginal cost? Who decided there would be a firm there? Okay, who decided this industry should be entered? Okay, who hired that manager and gave him a certain amount of capital resources to work with? Well, that is what is done in the capital markets, right? The role of the capital markets is to allocate resources to specific branches of industry and to specific firms within those industries. And, Mises argued, the market socialists have no proposal for that whatsoever. Okay, under market socialism, it's the state that decides where these socialist enterprises will be, how many there will be, what markets they will serve, what goods and services they will produce, and who will manage them. Okay, and that is the process that goes on, that the market accomplishes, that a planned economy simply cannot replicate. Okay, he says in another passage around here, he says the market socialists, they see the economic problem from the point of view, basically, of a plant manager. He uses the wonderful Misesian terms, a subaltern clerk. Okay, so the market socialists see the problem from the point of view of, a little hired hand who's given a little factory to run. And say, no, he says, that's not the main problem. The main problem is, how do you decide which activities get financed and which activities don't? Rothbard tells a great story that when he was a participant in Mises' seminar, they were talking about socialism, and the point was raised that it's sort of in the abstract, we can think of a theoretically pure socialist economy with no markets whatsoever, and we can also think of a pure laissez-faire free market economy. But when we look at actually existing economies in history, what we see is different kinds of mixes, right? So even under even the Soviet Union had black markets, and there were some markets for hard currency and so on. So there wasn't pure socialism there. And of course the U.S. and even the most capitalist of Western economies, Hong Kong or whatever, still have a sizable degree of state intervention. So the question was put to Mises, is there any way that you can sort of distinguish socialist economies from capitalist economies? Can you sort of draw a bright line and say, on this side of the line, you're basically socialist. On this side of the line, you're essentially capitalist. Or is it just a continuum, different shades of gray? And, I think they expected that Mises would say, well, no, it's kind of a gray area. It's just a scale. But Mises said, no, there is one criterion that distinguishes a capitalist economy from a socialist economy. And that is if it has a stock market. Okay, if it has a stock market. According to Mises, if an economy has a stock market, then no matter how much government intervention there is elsewhere in the economy, it's essentially a capitalist economy, hampered though it may be. Okay, if it doesn't have a stock market, then no matter how many black markets or markets for consumer goods they have, it's essentially a socialist and not a capitalist economy. Okay? Okay, let me just briefly touch on some kind of mainstream critiques that have been levied against the market for corporate control, this idea emphasized by Mises. Some mainstream critics have said that, well, the market for corporate control doesn't really work very well. It's not very effective in governing corporate activity. Some people have claimed that, use these kinds of arguments to claim that there are too many acquisitions, too many takeovers, that a lot of takeovers are not, corporate takeovers, whether by raiders or by other firms, are not really designed to weed out inefficiency, as in the story that I told, but rather are themselves forms of perk-taking by the managers of the firms doing the acquisitions. That managers like to grow their firms, and they may do it by taking over other firms, even if that isn't to perform some kind of disciplinary function, but rather just to enhance the span of control of the managers of the larger firm. Other critics have said there are not enough takeovers, because in these situations that I described, where there are potential gains from taking over a badly run firm and replacing the managers, there are some transaction costs, and there's a problem that some information theorists have written about, claiming that the raider, in fact, will not be able to take over the firm and make money, because if the shareholders of the target firm are smart, once the tender offer comes, they'll realize that, oh, well, the reason Michael Milken is offering me money for my shares is because he thinks he can change the management of my company, improve its performance, and then the shares will be worth more. So I'm not going to sell out to him. I'm going to hold on to my shares and hope that enough of my fellow shareholders will tender so that the raider will get control, but I'll just stay along for the ride. I'll hold on to my shares, and then I'll have them later when they're worth much more, and I'll make all this money along with Michael Milken. Of course, the problem with that is that these gains that the raider is seeking are uncertain, right? And many shareholders of the target may prefer the sure thing, the bird in the hand, rather than the two in the bush. So the stock is currently trading at $10 a share. The raider offers you $15 to give up your shares. You're not going to think, well, but it might be worth $20 if I just hold on to it for another 2 years. I mean, some shareholders may do that, but many will not. Okay? I think that the key thing to keep in mind is this point that those who engage in corporate control transactions are themselves entrepreneurs in the Misesian sense. That their actions are pervaded by uncertainty, not simply probabilistic risk, and that not all market participants want to bear that uncertainty. Okay, those who do and who are successful will end up earning profits. Okay? It's also interesting to think about the degree to which sort of the critics of the corporation ignore the fact that a lot of the problems that they're concerned about are themselves the product of government intervention rather than the free market itself. A lot of the alleged defects in the corporate form and in markets for corporate control are themselves the result of other government interventions. There's an interesting passage in Mises' 1944 book, Bureaucracy, which I highly recommend, where the entire book, it's a short book, where he distinguishes between what he calls profit management and what he calls bureaucratic management. Okay? Mises makes the point that in the mixed economy, a lot of corporate resources are directed not toward producing goods and services to satisfy consumer wants, but rather to meet regulatory mandates, to try to engage in lobbying, or rent seeking with the authorities, and so on. He lists in particular 3 factors that make the management of capitalist corporations less effective than they would be in the unhampered market. He refers to taxes and regulation that distort profit signals. Okay, remember in our previous discussion we talked about giving managers incentive compensation, tying their compensation to profits. or the use of profit signals to give information to other market participants that this firm is not being run so well. Well, in a highly regulated market in which profits are capped by regulation, in which the state limits the degree of competition and so on, well, then profit signals are not going to be very meaningful. Okay, regulated public utilities, profit rate doesn't tell you anything except what kind of relationship the firm has with the rate setting board, in that municipality. So that makes it difficult for shareholders to rely on these mechanisms that we've just described. Laws that interfere with hiring and promotion. Okay, who was it? I think it's Jan and also Brian that I keep talking about firing. What if I can't fire them because they're members of particular underrepresented groups, or they have their lawyers complain to the Equal Employment Opportunity Commission or whatever? If I can't hire who I want and fire who I want, that limits my ability to take advantage of these control mechanisms. Of course, the threat of arbitrary antitrust or regulatory activity makes managers devote a large part of their time to sucking up to the authorities. Okay, staying nice and cozy with the authorities, having a big fancy lobbying office in Washington, D.C., and whining and dining politicians, and so on. Mises has a great passage where he says, in the mixed economy, to be a successful corporate manager, you have to excel at bribery and diplomacy. Okay, you need a certain set of skills to navigate Washington. Look at a company like Enron, for example. The reason Enron was so successful when it was successful was because, Ken Lay, the CEO of Enron, was a former federal energy regulator. He was very close to the Carter administration. He knew how to navigate the regulatory morass. He excelled not in producing goods and services that satisfied consumer wants, but in understanding the highly complex sort of Byzantine web of energy market regulations. Okay, so to be a slick political operator is a huge advantage in the mixed economy. Did you?
Just a comment I thought was interesting. Average Fortune 500 CEO is about 2 hours.
Yeah, there's a lot of interesting literature too on the composition of boards of directors. That a lot of corporate boards have not only experienced managers, retired managers, investors serving on the board, but also celebrities, politicians, priests, people whose main function is public relations, and networking with various interest groups and lobby groups and being politically correct and so on. So that's a huge distortion, misallocation of resources. I also mentioned, this idea that, laws that restrict the role of outside investors like banks is extremely important. I would recommend to you a book by Mark Rowe called Strong Managers, Weak Owners, which describes in detail the artificial legal restrictions on the role of banks in the Anglo-American system and how this increases the degree of managerial control. Rowe argues that the Burley and Means problem, so-called, is really the product of restrictions on bank activity. Okay, finally, what about the role of the state in sort of creating the corporate form of organization itself, and the role of state intervention in supporting big firms? There's an argument that one reads in some of the libertarian literature that says that, the corporation itself is really a product of the state because corporations are governed by state-issued charters, right? So at least in the U.S., different U.S. states, the corporate charter has to be issued and certified by a state governing authority. A lot of them are chartered in Delaware in the U.S. because it has some favorable policies. People say that, the reason corporations have become successful, the reason that the corporate form is so widespread is because of so-called limited liability, right? So people will say that limited liability is itself an artificial legal intervention by the state. Okay, now what do we mean by limited liability? Well, there are two different notions of limited liability, right? Both have to do with the extent to which owners of a corporation are legally responsible for things that the corporation does. Okay? So, the first kind is what you might call just sort of financial or contractual legal limited liability. Right? So what that means is, under current U.S. law, if I'm a shareholder in Brian's firm and Brian's firm goes bankrupt, okay, and Floy is a creditor, she has loaned money to Brian's firm and he doesn't have enough money to pay the creditors back, Floy can go after whatever assets of the company she can get a hold of to try to get her debt claims back, but she can't go after my personal assets. Okay, I, as a shareholder, am financially liable only up to the amount of money I invested in the firm. Okay, so I might lose all my shares, but she can't come after my house and my kid's college fund and, whatever. Okay, whereas if I'm a proprietor or a partner in a proprietorship or a partnership, I can be liable for the debts of the partnership, including my personal assets could also be fair game for creditors in a bankruptcy proceeding. Okay. The other kind of limited liability that gets more attention among libertarians is limited liability against torts, against criminal acts engaged in by employees of the corporation. Okay, so if Brian pick somebody else, Jacob. Okay, so if Jacob is he's a truck driver for my company and he crashes into somebody, runs over somebody. Can that person or that person's family sue me as a shareholder for damages as a result of what my employee did? Well, under current interpretation of limited liability statutes, the answer is no, that only the employee is responsible for his own criminal actions, that shareholders cannot be held liable for torts committed by their employees. Okay, so some libertarians have said, well, but under libertarian law, shareholders should be legally liable for these things, and therefore people wouldn't want to be shareholders. Fewer would want to be shareholders, and we wouldn't have many corporations in a libertarian society. I think this argument is flawed for two reasons. First, it often fails to distinguish among the two types of limited liability that I described. The first type, the financial type, is purely a contractual issue. Excuse me. In other words, when Brian goes to borrow money from Floy, she's a bank or she's some kind of investor, the contract will specify, okay, in the event that he cannot pay, what recourse does she have? Can she go after the shareholders or not? Right? And that would be sort of a circumstance under which he tries to borrow money. So maybe some firms would say, yeah, we're going to let our investors be liable. We'll put that in the contract. Other firms will say, hey, as a condition of conducting this exchange, we hereby state that in the event of bankruptcy, you cannot go after the personal assets of our shareholders. Well, Floyd can choose to lend money to one type of firm or the other, right? And I, as a shareholder, right, presumably I'd be more likely to purchase shares in a company if I know that the company includes that language in all of its debt contracts, that I'm protected. I'd be less likely to invest in a company that didn't offer me that protection. But that's something that shareholders, managers, and lenders can all work out voluntarily through contract. Okay, you don't need any kind of state intervention to have those kinds of arrangements. The tort liability case is more complicated, right? All I would say there is that if you look at the history of corporate law, the idea of limited liability against torts for shareholders is very, very old. It is part of the common law that predates any statutes on record in which the state officially sort of sanctions this idea of limited liability for torts. That essentially what we have is when states began to do this, they were sort of certifying or ratifying a common law practice that was already, that was sort of already in place. Also, there's some interesting arguments that Kinsella has made. I can't remember now where he's written this, maybe just on blogs, that he participates on blogs, as you may know, more than anybody else I know. But he has argued that, the argument that in a free market, shareholders should be liable for torts committed by their employees is itself a not very well articulated argument. That's just sort of asserted by libertarian libertarians who make this statement that the corporation is artificial without much argument, and that it's not at all clear from the point of view of sort of libertarian law that they should be liable for torts, that this issue needs a lot more exploration. Let me talk, since we're low on time, let me talk a little bit about the so-called sort of mutualist, left mutualist position. Roderick and I had some back and forth on the Mises blog and elsewhere about the claim that Roderick gets mainly from Kevin Carson that the large size, the fact that we have so many large companies is also an artificial product of the state. Carson refers specifically to subsidized transportation. He says a company like Walmart would never emerge in the free market because the only reason that Walmart's business model works is because of government roads and government subsidized, trains and so on. That if we really had a free market for transportation, the transportation costs high transportation costs would prohibit the kind of model of very centralized production and then distribution to far off locales. You wouldn't have nationwide chains. You wouldn't have large factories or large retailers in a purely libertarian society, according to Carson. And I think this is wrong, historically wrong. For a couple of reasons. First of all, it's certainly true that large firms benefit from state intervention, but small firms benefit from state intervention, and both large and small firms are harmed by state intervention. Right? I mean, it's very difficult to kind of net all of these things out. So yeah, I mean, to some degree, subsidized transportation benefits disproportionately firms whose business model is based on volume and transportation distance. But I mean, small firms have access to the same network of subsidized roads. Small firms benefit from regulations such as antitrust that disproportionately affect large firms. There's a whole series of interventions that target firms of various types. And, you can come up with a list of specific policies that benefit large firms and then a list of specific policies that benefit small firms. How those things net out, that's a very complex sort of philological, historical question. It's very difficult to say ex ante which of those effects would sort of outweigh the other. And finally, I think the mutualists, the left mutualists, what they argue is that in a purely free market society, instead of corporations, we would have a lot of cooperatives. The dominant form of organization would be sort of small worker-owned cooperatives. They have sort of like what was called cottage production before the Industrial Revolution, households and small groups of workers that would band together to jointly own and produce goods and services. I think the argument for this is very weak. Essentially what the mutualists have done is to say, well, under, the corporation, you have separation of ownership and control, or what in modern language is often called a principal agent problem. All the things we've just been talking about for the last hour. Therefore, corporations could not exist on the free market unless they were subsidized by the state. Okay. Problem is there's a whole literature in organization theory, in organizational economics, and organizational governance on the problems that accrue to partnerships, cooperatives, and proprietorships. Okay, they have a series of ownership and governance and control problems as well. There are very serious sort of collective decision-making problems in cooperatives. Partnerships are limited they have limited ability to raise capital, and they have a lot of issues associated with succession. It's much more difficult to exit a co-op or a partnership than it is to exit a corporation as an owner. There's a whole host of issues, again, with no ex ante or obvious conclusion as to which form of organization is sort of, in general more efficient. I mean, in fact, what I would expect in a purely free market society is a variety of organizational forms. Some proprietorships, some partnerships, maybe some cooperatives. It should be said, by the way, that cooperatives in the U.S. benefit from a huge series of federal government interventions, particularly in agriculture, where the co-op is a dominant organizational form, antitrust immunity, price subsidies, tax benefits, and so on. But even absent that, maybe there would still be some co-ops, and there would probably be a lot of corporations. There's no one-size-fits-all sort of model for what kind of legal form is most appropriate for a firm. Okay, so I don't think this left mutualist critique of the corporation is very solid. Okay, we only have a minute or two left, so we have time maybe just for a couple questions. I'm sorry, actually, you had your hand up first, and then here.
I see subsidized energy in small firms. I would say that both on the edge benefit large firms. Subsidized energy means that large firms often have higher costs.
Right. The argument there is that in the absence of energy policy, right, large firms, it's more likely that large firms could produce energy internally, okay, whereas small firms necessarily get energy from the grid, okay, and the argument is, this sort of cottage production model where we don't transport goods across borders, but I still have my own little factory in my house, and I use the telephone, I use the internet, and I have electricity. Well, that all comes from a subsidized network. If we didn't have any of those subsidies, I think it's much more likely that we would organize production in larger entities that could, if necessary, generate their own electricity. Okay? Yes?
What do you think of this being made by isolation between physical person and moral persons? The root of this.
Yeah. Do you mean legal persons?
Well,
I'm not sure what you mean by physical persons and moral persons.
Well, I don't know maybe the English equivalent, but individual physical persons
yes.
in terms of law, and some are what we call moral
Okay.
persons.
Yeah. In English, legal persons is what you mean. Right. So the question is, what about the so-called legal personhood status of the corporation? Mark's looking at me. We need to stop. That it's true that under and in fact, under the common law as well, that certain groups of individuals could be treated as a person in the legal system, meaning that a corporation can sue and be sued. Okay, again, while sort of statutes have essentially ratified this convention, I don't think the convention itself is a product of those statutes. That even before those interventions, the idea that a group of people could be represented legally as one entity is, again, sort of a common law arrangement. Okay? We need to stop, so thanks very much.